Markets digesting the U.S. and China's 90-day trade truce. Joining us now, Stephen Roach, senior fellow at Yale University's Paul Tsai China Center, and Greg Ip, chief economics commentator, deputy economics editor at the Wall Street Journal. Thank you both for joining us this afternoon. Stephen, I want to start with you. Obviously, these are negotiations and not deals. The stock market may be trading like they're deals, but they're still negotiations. What do you think is the likelihood of the final deal between the U.S. and China looking like this truce, this negotiation?
Well, I don't think we have any idea right now. I think it's clear that the president has flinched, blinked, whatever you want to call it, relative to the outrageously high tariffs he had slapped on China in a fit of anger after China dared to retaliate from Liberation Day. But I think there are certainly good grounds for the U.S. Continuing to put more pressure on China through higher tariffs than it will for other trading partners. This is a mistaken view from my perspective, because the idea of imposing a bilateral penalty on one nation to try to bring down a large multilateral trade deficit with over 100 nations just won't work. But that's the mindset that prevails in the Trump administration and in Washington as large. So, I think you can certainly look for China. If Trump settles on 10% universal tariffs, and for the world as a whole, he's going to hit China with more than that.
Greg, I want to bring you in here as well. Tyler, your column this week, Greg, which I read, Trump's China deal makes sense. How he got here doesn't. Walk us through that, Greg. What do you mean?
Well, at the end of the day, we're ending up, when you include the tariffs that Trump inherited from the previous years, you add the 20% tariff that was added for fentanyl, and now the 10% reciprocal tariff. The effective tariff, once you account for all the various exemptions, is about 39%. That's really high. I mean, it's the highest tariff we've ever had on China, the highest tariff we've had on anybody for a very long time. And it looks like it'll be much higher than any other country has. And I think that's appropriate. I think most people on both sides of the aisle think it's appropriate that China is not like any other country, that it is a geopolitical adversary. It doesn't play fair on trade. It discriminates against Western companies, and it wants its natural champions to dominate technology. It makes sense to treat China worse. But the way we got here doesn't make any sense at all. I mean, to start at 34, go to 145, drop it at 10, and drop it to 10%. That's just the reciprocal piece, I should say, and get nothing in return for dropping it to 10. I think kind of really sort of like raises questions about just the quality of Trump's deal making and, whether there's any internal rationale to any of what he's been doing.
Greg, I want to just bounce one argument off you because I'm just interested to get your thoughts on it. The way it's framed right now by a lot of folks is that Trump retreated, and maybe he did. But it was interesting, my buddy John Carney makes another point, and John pointed out, and I want to get your take on this, maybe it's not a retreat, John says. Maybe it's a pause. It's more like a strategic pause, is John's point. And Trump takes these 90 days, Greg, and he'll try to punch through these other measures, punch through tax cuts and deregulation. He lets Bessent keep playing the role of sort of, good cop. But if Trump doesn't get what he wants and Xi does not deliver what he would consider material concessions, maybe Trump comes hitting right back and reimposes tariff escalation. What do you think about that argument?
Listen, like Steve, I have no idea what's going to happen over the next 90 days. I think that where we are today is probably a pretty good bet on where we end up. But sure, I think negotiations could break down and tariffs could go back up. But just because there's more to come doesn't mean it makes sense to how we got here. There's nothing that could have stopped the president from just starting at 10%, if that's where he wanted to end up, and then ratcheting it from there instead of effectively doing the opposite. Therefore conveying the image, whatever you think of the reality, that he capitulated.
And Stephen, I want to bring you back into the conversation because to the point that Greg is making, one of the key questions from the investors on Wall Street who I talked to They just want to understand what the goal was of these tariffs in the first place so that they can have a framework for thinking about the administration's moves going forward. Where have you gotten clarity on the administration's specific goals when it comes to trade deals with China?
Well, first of all, I have to say I get much more clarity over the years in reading Greg Ip in the Wall Street Journal than I do from reading the policy statements from the White House. But his point on how we got there is absolutely critical, and the message is not in the actions that President Trump has taken, but in this sort of strange philosophical view that he has addressed, that America's been ripped off for decades, and we're going to put a price tag on the ripoff in the form of these 10% minimum or universal tariffs, as he calls it, and that is the price that we're going to charge the rest of the world for taking advantage of us. And that is a really high price relative to the tariff rates that have been that we've been running over the last 30 years. Which, if you look at the numbers put together by a group at Yale, the Yale Budget Lab, our effective tariff rate for the rest of the world has been a little less than 2% over the past 30 years. So we're going to go from 2 to 10. That's a 5-fold increase. That's a huge tax on our companies and on our trading partners, and not without significant impacts on the broader global economy. So there's not a whole lot of strategic wisdom in this approach, in my view.
Kevin, I want to bring you back.
Can I just say how much I agree with what Steve just said? I can make a case for why we should have a 39% tariff on China. I cannot make a case for why we have a 10% tariff on Great Britain. I mean, in fact, if you look at the actual underlying rationale, the 10% tariff on China is the same as the 10% tariff on Great Britain as part of the reciprocal tariff action announced on April 2nd. What was the purpose of that action? Supposedly, we were going to punish countries that were running unacceptably large trade surpluses with us. China is a geopolitical adversary with a huge surplus with us. Britain is a stalwart ally, our best ally, with a trade deficit with us. And they both get 10%. I mean, what message does this send to the world about how the United States picks its friends?
Well, Greg, it's a great point, but before we let you go, I want to get a sense of how this impacts the consumer. Kevin Gordon with Charles Schwab was telling me earlier this week that we could actually see a bigger pass-through of inflation of costs to consumers with this lowered potential tariff rate, because companies are more willing to pass on a 39% rate than they were a potential 145% rate. Greg, how do you view that? Are consumers going to feel inflation more, even if some of these tariffs are negotiated down?
It's definitely the case that 145%, which Treasury Secretary Bessent said was like an embargo level, trade just comes to a halt, so nobody pays that tariff. Right. So, however, if we compare today with where we were, say, on January 20th, yes, at some point these tariffs will pass through to consumers. They will pay this. Now, how big will that effect be? That part's very hard to say. And I will say, in fairness, that the April CPI data that we got just a couple of days ago shows that the pass-through from tariffs so far, it's there, but it's small. So maybe it will not be perhaps the economy wrecker that a lot of us were worried about a month or two ago.
Stephen, Greg, great to see both of you today. Thank you so much.
Thank you.